Some people don't need a better investment plan. They need one that's simpler, more peaceful. So if you're a nervous investor, a novice investor, or someone who's just not quite sure you know what to do right now, this is for you. I'm going to talk about a way of investing that is low cost, simple, and focused on long term growth. So we'll discuss ETFs, exchange traded funds, the quiet workhorse of a great investment plan. A quick disclaimer here: I'm not a financial planner. Don't consider this advice, consider it education. I'm telling you what has worked for me over the years. So if you're just getting started, make sure to do some research, do your due diligence, or talk to a good financial planner. And remember, it's not a sign of weakness to ask for help. It's a sign of strength. It's a sign that you're determined to succeed at something and you're willing to do what it takes to get there. So let's demystify ETFs. So, what is an exchange traded fund? Well, it's a way to make one purchase but own many different assets. It trades like a stock during the day, but it's diversified like a mutual fund. Think of it as an all access pass to investing. You can invest in an entire country with one purchase, or even almost the entire world, or you can focus in on just a sector that you're interested in, such as dividends or financials or energy. So, what are the differences between a mutual fund and an ETF? Well, first of all, the way they trade. An ETF trades during the day with the price going up and down as it's bought and sold, whereas a mutual fund is only priced once per day. Now, the next difference is how they're managed. An ETF is often, not always, but often passively managed, which means if it follows an index, it simply owns all of that index. Say the TSX, it owns every stock on the TSX in proportion with how much of the market that stock makes up. That means there's very few decisions to make, and that means less work for the managers to do. Whereas with a mutual fund, the managers are trying to beat the market, so they're often buying and selling stocks, changing the mix in the mutual fund, creating more work for the managers. That translates into higher fees. So the fee you're going to pay with an ETF might be as low as a tenth of a percent, or maybe up to 0.25 or 0.3%. Whereas with a mutual fund, you're going to be paying maybe 2.5 to 3% of the portfolio to the managers every year. Now, that might not sound like an awful lot, but over the course of decades, that can make a tremendous difference in the value of your portfolio. In a high cost mutual fund, after a few years, well, let's say a few decades, the manager may actually have made more off your portfolio than you did. In a previous video, and I'll put a link up there, I mentioned how compounding can work for you, but when it comes to fees, it can also work against you, especially as you approach retirement and especially as you're in the years of withdrawing your investments. Now, if you've got a good fund manager that's making you a lot of money beating the market, that fee may be worth it. But it's something to keep in mind as you're making your investment decisions. It's been said many times, and I'm not sure who originated this idea, but it's not timing the market that's going to make you money, it's time in the market. If you miss just the best 10 trading days of the year, it can have a huge impact on the value of your portfolio. When people or fund managers start selling stocks because it's not looking so good and then waiting for the market to recover to buy them back, basically they're crystallizing or solidifying any losses that up to the point they sold were simply on paper. If you miss just the 10 best trading days of the year over a span of a few years, here's how it can make a difference. If you start with $10,000 and simply leave it in there, ride out the ups and downs of the market, your investment might go to, let's say, $30,000. If you're jumping in and out of the market, and you miss those 10 best trading days, just 10 days out of 365, instead of 30,000, you'll end up with 15 to 16,000. That is quite a difference. So, don't miss the good days by trying to avoid the bad days. Staying in an ETF does pay for itself. What do ETFs do well? First of all, they're very simple once they're explained to you. Secondly, it gives you broad exposure to a whole range of investments. Through one purchase of an ETF, I received shares in over 7,000 different companies. Granted, it was small shares, but I was that diversified. They're very low cost and it gives you clear, predictable returns. You won't beat the market like you might with the mutual fund, although most mutual funds don't have a long track record of continuously beating the market. But by investing in a market ETF such as the TSX or the S&P 500, you will always match the market or come very close to that. So what do ETFs not do? Well, they can't prevent risk. They don't prevent downturns in the market, and they certainly don't replace thinking and common sense. Are they for everyone? Probably not. Some people are better to work with a good financial advisor or even call their own shots if they have the confidence and the knowledge. But if something simple will help you sleep better at night, that is a huge win right there. I first learned about ETFs through a book called The Millionaire Teacher by Andrew Hallam, a great resource if you want to look deeper into this whole idea. He doesn't teach people to be millionaires. He is a teacher working overseas who is a millionaire and did a lot of it through investing in low-cost ETFs. A great resource. If you want to still learn more and get an idea of how best to use an ETF, tune in next Friday when I'm going to talk about a concept called couch potato investing. And it's pretty much what it sounds like. You invest passively the way the ETF invests passively. It's low cost, it's simple, it gives you broad diversification with the purchase of 2 to 3 ETFs, and best of all, you can manage it in about 15 to 30 minutes a year. Less tinkering, more living. If these videos are helping you to understand investing just a little bit better, please consider buying me a coffee in the link below. It helps to support the channel, keep my lights on, and keep the videos coming. So thank you for spending a few minutes with me today to talk about ETFs. We'll see you next time. And in the meantime, check out these other videos. Take care.